In this video, we're going to take a look at another application of the rate function. The rate function in this case is to determine the rate that we'll be paying on a loan. So we know how much money we can borrow, and we know how often we're going to make payments and what the payments are going to be and what the term is going to be, what kind of interest rate is required for all of that to work out. So in this example, our present value, the loan amount, is $50,000, and our regular payment is going to be $300, and we do 12 payments per year, and the number of years is going to be 30, and the ending balance on this loan is going to be 0, and we're going to make our payments at the end of the month, which is a 0. And once we've done that, all we need to do is go use the rate function to determine what the rate per period is going to be. So go to our financial book here and scroll down to the R's and rate, and the number of periods is going to be this. The payment is always negative, so the payment is going to be negative 300. The present value in a loan is positive, whereas with savings it's negative. That's basically the only difference in all of these problems. The future value is how much we owe when we're all done, and the type is going to be beginning or end. And click on OK, and it tells us that we need about 0.5%, but interest rates are almost always given as annual numbers, so it's going to be this number multiplied by the number of periods per year. And again, don't use 12. Use the cell reference, so if this problem changes, you don't have to change formulas. So it looks like we need an interest rate of just a little over 6% in order to be able to pay that amount off with those payments for 30 years.